Welcome to This Explainer. Today, we're tearing apart the engine of profit to figure out exactly how modern banking functions. To really grasp the sheer velocity of modern finance, I want you to start by picturing a highly personal scenario. Imagine walking right into your local branch with a crisp $1,000 cash deposit. You hand it over to the teller, your banking app immediately updates, and, well, you feel pretty secure, right? But the life cycle of that actual physical money, it has literally just begun. Okay, let's dive into this. Does your money just sit there in a giant steel vault waiting for you to come back? Absolutely not. While that cartoon image of a bank safe is super common, the reality is more like a high-speed logistical network. For a bank, every single idle dollar is a wasted opportunity. The absolute bedrock of the banking industry is velocity. Moving money is way more lucrative than just storing it. Because of something called fractional reserve banking, institutions really only keep a tiny percentage of deposits actually on hand. The rest, it's immediately deployed right back out into the market. Think about it like this. If an institution pays you, say, a tiny 1% yield for keeping your money with them, they aren't just holding on to it. No, they package that exact same liquidity into a mortgage or a business loan, but they charge the borrower something closer to 7%. This gap is formally known as the interest spread, or the net interest margin. That 6% difference, that is the primary profit engine. Now, sure, a 6% gap doesn't sound totally world-changing on a micro level, but when you apply that to billions of dollars in daily volume, you're looking at one of the most relentlessly reliable business models in human history. Let's move to and see how this builds, because lending is actually only half the equation. Think about all those everyday actions, grabbing lunch with your debit card, transferring money online, or sending an international wire. These all generate interchange and processing fees. They seem like microscopic fractions of a cent, but they aggregate into an absolute mountain of pure, non-interest profit. There's a great saying. Most people see a credit card as a convenient payment tool. Banks see a business opportunity. Credit cards are essentially the ultimate double threat for the industry. Fun fact for you, banks actually have a nickname for people who pay off their balance in full every single month. They call them deadbeats. Why? Because the real gold mine is revolving credit. Those surprisingly high interest charges on unpaid balances make credit cards the single most lucrative product in their entire portfolio. Which brings us to a pretty wild macroeconomic realization. Can commercial banks actually create money? I know it sounds totally illegal, maybe even a bit like magic, but they literally do it every single day through what's called the money multiplier effect. Just watch how this whole thing cascades. Credit becomes available, right? That allows businesses to expand their operations and hire more people. Those new jobs put wages directly into consumers' pockets, driving up spending, which in turn triggers even more corporate investment. So your initial deposit is mathematically multiplied as it ripples outwards through the entire economy. It's the engine keeping everything moving. But, and this is a massive but, this economic engine has a fatal vulnerability: default. What happens when businesses fail? People lose their jobs and borrowers simply don't repay. Because remember, the money the bank lent out was actually yours. A wave of bankruptcies doesn't just hurt the borrower, it directly and profoundly threatens the bank's own solvency. To mitigate this massive uncertainty, risk management becomes absolutely everything. Banks ruthlessly answer one single question: will this person pay us back? Underwriting algorithms are constantly evaluating creditworthiness, verifying income, auditing financial history, and assigning credit scores. By effectively predicting lower risk, they directly guarantee higher, much safer margins. Yet, even with all that tight underwriting, the ultimate nightmare is still the bank run. Because of those fractional reserves we talked about, the physical vault is mostly empty. If trust evaporates and rumor starts and everyone demands their cash at the exact same time, like we saw with Silicon Valley Bank recently, or historically during the crash of 1929, the institution just instantly collapses. Confidence is literally the only glue holding this entire system together. That's exactly why governments heavily monitor these institutions and why central banks and entities like the FDIC step in to provide deposit insurance. It's carefully designed to achieve three crucial goals: protect customers, maintain unshakable systemic confidence, and mathematically prevent the sheer panic that triggers a run in the first place. So the crucial point is, really, a bit of a paradox. Banks are ruthlessly profit-driven businesses, for sure. Yet they essentially act as a massive public utility. By aggressively chasing that yield, they inadvertently perform these incredibly essential functions. They connect capital to innovators, they facilitate global trade, and they provide the essential plumbing that supports our entire baseline of modern economic activity. Which brings us right back to your initial $1,000 deposit. It isn't just resting peacefully in a vault somewhere. The very second you hand that cash over, it becomes the vital liquid fuel for this whole global engine, actively funding the broader economy while, of course, netting the institution a very healthy spread. It completely changes how you view a simple checking account, doesn't it? You aren't just storing cash. You are an active participant in this massive machine. So, the next time you tap your card or make a deposit, ask yourself, whose engine are you really fueling? Thanks so much for joining me for this explainer, and keep questioning how the systems around you actually work.